is that with so much computerized trading now, that it's a pretty good idea to have these in place. Now, again, we've hit them several times over the last 2 weeks, and it doesn't necessarily mean that they've kept the markets from going down, but we can certainly take a pause and to realize whether these are intended consequences or just a figment of increased electronic trading.
So you mentioned a couple times parallels to '08. What are some of the parallels and what are some of the real differences between the market response in the global financial crisis and today's coronavirus markets?
It's funny you say that because when I talk to a lot of market participants today, a lot of clients, a lot of colleagues say, well, in '08, we knew what we needed to be done. It was a bank and mortgage liquidity crisis, and it needed to be fixed. And it was just a matter of having the gumption to actually do it, which, of course, living through that at the time didn't seem as if it were very obvious what needed to be done and if it could be done. In this example, though, a couple things are different that, like I said before, it is an exogenous shock. This isn't like just over leveraging the system at the time for it to come out. But what also is different is just the ability for policy response when we were almost at close to zero interest rates and even negative interest rates around the globe. So there's less of a cushion for the central banks around the globe to add liquidity to the system. But that being said, this is also very different because liquidity is not something that is going to solve people that are living paycheck to paycheck that now aren't going to be paid for a while. So these are real economic problems that we have and we're going to have in the next couple of months. So I think the politicians and regulators are actually, from America's perspective, surprisingly getting their act together and doing, and being very aggressive, which I think is all you can ask for. Now, they're not going to just create a couple of months of GDP out of nowhere, but as far as the responses, it's as good as it can be.
So, Joe, you talk to a lot of different clients. How are clients positioning themselves right now? And are there any bright spots across all the asset classes?
Yeah, I think there are bright spots. I think that anytime that we go through one of these bear markets and recession, which is looking more and more likely, that there are positions that need to be either unwind or moved that our clients have to do. And those are obviously come at sometimes distressed times. So we feel pretty good about our ability to help clients mitigate those difficult circumstances as well and to navigate those as well as can be hoped. The thing I'd say is that, if you asked me this question even just a week ago, I would have said that clients had not really come to the realization what was happening. And granted, markets were higher then. But if this week was one of the busiest weeks that I've really ever been associated with, in the first 3 days of the week, and we definitely saw some of the processes that you would like to see that need to happen in order to form, a less volatile period. I'm not going to make any opinions on whether the market goes higher or lower from here, but you're certainly seeing some evidence of getting positions in better shape. So, if I had to say what are the things that you're probably most excited about is the fact that there has been a lot of cash raised and that many of our clients, especially some of the people with longer term money, are in a very good position to be investing right now, to be aggressive. And we feel pretty good about our position to help them do that too. So, looking at some of the things that we have invested in over the last couple of years, especially the human aspect of the business where, we thrive ourselves on the relationships that we have with our clients. And that's something that clients are really appreciating during these difficult times, and we're getting the first call.
So next week, sort of one of the primary symbols of capitalism in markets, the New York Stock Exchange will be closed. They don't want to put their employees at risk. And so they will be moving to full electronic trading. Obviously, we've seen that on other exchanges.
There's a couple of exchanges that have kept some of the, and there's different arguments for plus and minus, but have kept some of the legacy floor operations, CBOE, CME, NYSE very publicly. We see it all the time on CNBC. And but largely, you have to remember that New York Stock Exchange is really in Mahwah, New Jersey. That's where their servers are. That's where the the actual trades are happening. The floor is largely for opens and closes of the marketplace. That's handled by humans and has human intervention. One can make an argument that that does create a bit more of an orderly open and closes, and one can argue against it, by the way. But largely, they seem to have very good backup plans in place. We'll know next week. But there are plenty of markets and exchanges that operate solely electronically now. So I think anytime there's any changes, we always have to be cognizant of operational risks. So are we, anytime, people aren't used to sending orders a specific way, you have to be careful. But in general, this is probably more in line with more electronic markets. So we feel okay about it.
Okay, well, so amidst all the drama and the negative news and the understandable concern about the health of our country, any positives that you saw this week? Something you saw at the office or at home?
Yeah, there's a lot of positives. For one, there's watching some of our employees that probably have been remotely working for a while now. Some of whom were either in compromised situations or felt like they wanted to be at home. We were very supportive. There's a couple of people that work for me that have been highly engaged and while they're at home, and that's been a really pleasant surprise just to see how much people that are in personal risky situations are really engaged, and they're obviously putting their health at first. And that's what we want them to do, but just how much being a part of Goldman Sachs means to them, and is really an outlet and a fun thing for them to do while they're, I think we all have a bit of a cabin fever these days. Another thing that comes to mind, I was really pleased about the executive office's approach to helping the community, especially in small businesses. I think, I personally live in New York City and see, a ton of small businesses, whether it's the local restaurant or the local gym or, dry cleaner. Those are things that I think we all, as not only Goldman Sachs partners, but members of the community, that we want to make sure that we're putting the community really in the top of mind for us, and that's something that we're all gonna. I think every partner that I've talked to is really excited about actually giving money towards the cause, towards this cause, and to fortify the community. So it's really been a pleasant thing for us to talk about.
All right. Well, Joe, thanks for joining us this week. I know you've been super busy, so we appreciate you taking the time.
You bet. Thanks, Jake.
That's all for this week's Markets Update on Exchanges at Goldman Sachs. And in case you missed it, check out our other episode this week with Goldman Sachs Global Medical Director, Dr. Michael Rindell, who talks about what employees and managers can be doing to stay healthy and productive while working remotely during this pandemic. Thanks for listening, and hope everyone's staying healthy and well during this challenging time. This podcast was recorded on March 19th, 2020.
All price references and market forecasts correspond to the date of this recording. This podcast should not be copied, distributed, published, or reproduced in whole or in part. The information contained in this podcast does not constitute research or a recommendation from any Goldman Sachs entity to the listener. Neither Goldman Sachs nor any of its affiliates makes any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast, and any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. The views expressed in this podcast are not necessarily those of Goldman Sachs, and Goldman Sachs is not providing any financial, economic, legal, accounting, or tax advice or recommendations in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by Goldman Sachs to that listener, nor to constitute such person a client of any Goldman Sachs entity.
This is Exchanges at Goldman Sachs, where we discuss developments currently shaping markets, industries, and the global economy. I'm Jake Seward, Global Head of Corporate Communications here at the firm. Today we'll be talking to Dr. Michael Rindell, Goldman Sachs' very own Global Medical Director, about how a firm like ours responds to the coronavirus pandemic and what we all can be doing on the individual level, including tips for staying in good shape mentally, physically, as more of us start working from home. Dr. Rindell, welcome to the program.
Thanks for having me. Happy to be here.
Dr. Rindell, Before we get to your role specifically at Goldman and how you prepare the firm for a health crisis like this, let's talk a little bit about some of the most common questions we're getting from our clients and others about the course of the pandemic and the specific challenges, unique challenges it raises for healthcare professionals and everyone really who's dealing with its consequences. So how would you describe the state of testing? It's different region by region, but maybe start with the U.S. Why has it been so hard to get people tested, and why have the protocols varied so widely region to region?
All right, so let's start with the U.S. Unfortunately, in the U.S., the testing kits that the CDC were developing and manufacturing ended up being faulty. And so they had to sort of scrap all these kits that they had and then start all over again. And so because of that, we got behind in having enough testing kits that we anticipated we would need when the coronavirus reached the U.S. We've been ramping that up. And I think key to also that is allowing commercial labs like Quest and LabCorp, for instance, to start creating these test kits and being able to perform the test, because, we're used to using commercial labs and they have a huge capability of doing many, many, many tests at the same time, and they have good quality control. So that's going to be really to our advantage. So what we're going to see over the next few weeks is much greater access to testing. Part of the issue, ironically, it won't so much be the lab being able to run the test, but figuring out the right way for doctors and other healthcare providers to obtain the swab so you can submit the test. We don't want lots of sick people with COVID-19 coming into emergency rooms or doctors' offices where they're going to spread the infection to other people, particularly other people who might have health conditions that will make it more dangerous for them to get infected. So hospital systems and practices are figuring out now what is a safe way for people to get tested in special areas. They've done it in parking lots. And once that gets ramped up and there's more access to testing, we're going to have a better idea about what this disease is. Right now, because there's so few kits, we are testing people mostly who have more serious disease, whether they're in the hospital or more serious disease at home. By being able to open up that testing, we'll have a better idea about milder disease and how prevalent that is compared to more serious disease, and really get a better sense of how transmissible this is, and again also about how serious and even the mortality rates. They'll be easier to understand what they truly are by doing more widespread testing. So right. That's in the U.S. The same is really holding true for a lot of these other countries that also don't have enough testing kits, and some of them have very strict criteria for testing. So it's hampering our ability globally to really understand the spectrum of disease that we're seeing.
In another area that people are focused on rightly is therapeutics, and what's the likely course of therapeutics for COVID-19?
Well, there's a drug right now that's undergoing clinical trials both in the U.S. and outside the U.S. called remdesivir. This was an antiviral that was developed, I think, a few years ago in the hopes of treating Ebola. It didn't work for Ebola, but it looks promising on an anecdotal level in a couple of case reports that it's effective against this coronavirus strain, SARS-CoV-2 as they call it. So there are a lot of clinical trials ongoing for that. I think that's probably our best hope for a treatment. There have been some other treatments that they've tried, combinations of Tamiflu, which is an influenza treatment, and an HIV treatment. Those are really anecdotal reports, and I'm not really sure whether or not those are moving forward on a more widespread basis.
And of course, vaccines. Obviously, the vaccine will be late for the outbreak, but what's the prospect of having a vaccine in place that would take care of this in future years?
Well, most experts are saying a vaccine will take a year to 18 months to develop. And the reason for that is, vaccine trials, they need to be safe and effective. So phase one is understanding what a safe dose and whether the dose that they've developed is safe in people. The second is, what is the effective dose? They have to figure out exactly the efficacy. And then the third is a large-scale clinical trial with lots of people to see exactly how people mount an antibody and whether or not they think that's going to be effective. That just takes time, and you have to get enough volunteers. And so really, I think it's only reasonable expected to be 12 to 18 months before we get a vaccine.
All right. And finally, we've seen obviously in Italy, the healthcare system getting overloaded. You talked earlier about why social distancing is so important for the healthcare system as a whole. But how about the state of the healthcare system I guess here in the U.S., in terms of hospital beds, the machinery that's needed to treat this, and also just the ability of healthcare professionals to function in this environment?
Yeah, no healthcare system is going to have enough beds to treat as many people as might be predicted in any large pandemic, this one or any other one. Ultimately, if there are enough sick people, the healthcare system will get overwhelmed. It's not built for a pandemic. And so we really need to be careful about our resources. Part of the mortality of a pandemic isn't just people who die of the infection, but also people who don't get access to care for other reasons because the healthcare system is overwhelmed. So I think the things that we need to do are both, A, protecting our high-risk patients, so we're going to have a more difficult time and a more serious disease, to make sure they don't get infected so that they don't need the kind of intensive treatment in a hospital or a healthcare setting that will take away from other people being treated at the same time. And then the second is making sure that, again, we have the right staff in place, that people are using the right protective equipment. It's important that people use gowns and masks. There's very standard criteria for respiratory droplet infection, airborne infection. And so our hospital systems are ready for that on a routine basis, but they're preparing now and gearing up for an overwhelming number of cases. And so we just have to do our best to be patient and make sure that we're not overwhelming our healthcare system with other things that we can put off in the short term to make sure that they can focus on the needs of people who are seriously ill.
So obviously this is a moment that no one wants to experience, but that you and your team have been preparing for a long time. So how does a global firm prepare for a crisis like this?
Well, every firm has a business continuity team where they spend time preparing, planning, testing, and what we would call peacetime. And during peacetime, we're looking at not just our capabilities from a technology standpoint and from a people standpoint, but our job on the medical side is from a medical standpoint, how are we prepared? So we look at things like, do we want to stockpile medications? For the most part, we don't really do that. Nobody really does that because we don't want to be in the business of providing direct care to our employees. But we look at other things like what kinds of other strategies we would put into place to help mitigate any kind of outbreak should it occur. We want to understand our healthcare providers who are on site at some of our locations. How are they going to deal with something that would happen, whether it be a respiratory infection or a different kind of infection? Ebola, for example, is a contact infection. It's not from a respiratory. Making sure they're well protected. They would know how to deal with this kind of event in the workplace. How are we going to provide the right treatment and the right information to people? That's sort of what we do on the medical side as part of the larger business continuity team when they plan for an event such as this.
Increasingly, our firm, like many others, is encouraging many employees to work remotely. In fact, today here, there are probably more people working from home by a long shot than are in the building. So what's the general strategy behind limiting people in the building?
So with the coronavirus infection, the key to suppressing this infection is really around social distancing. And so they've been finding in China and other places that social distancing has really made a huge difference. So that by limiting contact between people, we limit the number of infections that can happen, and that can really make a big difference in the long run. So if we look at the sort of arc of a pandemic or arc of an outbreak, when the infections get to be a very, very high number, not only is it bad because lots of people get infected, we end up with people with high-risk conditions who do poorly get infected, and then the healthcare system gets overrun. And so the key is to push down that arc and make it much lower so that there are fewer infections during the course of an outbreak, so that healthcare can be delivered effectively, and that we protect particularly people who are at high risk. And in coronavirus, it's people over 60, people with chronic medical problems, pregnant women, people who are immunosuppressed. We want to make sure that those people are protected specifically because they could have a more adverse outcome compared to, say, young people. That's different in different viruses. Sometimes young people are more infected or children are more infected. That is not the case with COVID-19.
Obviously, I should say for our listeners that I'm in one room and you're in another. So you're at home and I'm here in a room by myself. So we're doing some social distancing. Other than limiting the number of people that are actually together in a building, what other preventative measures is a firm like ours taking?
Well, I think one thing that's really important is the messaging we give people. And sometimes we have to give it over and over again because we want it to really be impactful. And the most important thing is to isolating yourself when you're sick. We really want to emphasize strongly that in order to help not pass it from person to person, if you're sick, you need to stay home, you need to self-isolate so that, during your period when you're infectious, you're not really passing an infection to others. That also means monitoring your health, be really mindful of your own symptoms. With COVID-19, the most common symptoms are fever, cough, and shortness of breath. If you're developing those symptoms, you want to make sure you're careful to speak to your doctor and stay away from other people who are ill. And if you're ill, stay away from others so that you don't pass any infection along. The other things we talk about, they seem a little bit simple, but sometimes it's hard for people to do it. Washing your hands frequently. Don't touch your hands to your face. Making sure you stay at least 3 feet from each other, between 3 and 6 feet, because respiratory droplets travel around 6 feet. And so we stagger our workstations. Even when people who are coming into the office, we make sure that they're more separated than we normally would. Hand sanitizer, which is hard to get these days. Using hand sanitizer when you don't have access to washing your hands with soap and water. Those are the kinds of things that we are doing, even for people who are coming in, whether they're inside the building or outside the building. It's important for them to think about this thing.
Dr. Rendell, one question that we've got quite often in our offices, as we've had some confirmed cases of COVID-19, is how should we feel about the safety of our workspace? We use this phrase and see this phrase, deep cleaning, all the time. What's effective in that space, ensuring that it's safe for other people to come to work after we've identified a case?
So we know that coronaviruses, such as the one that's called the cause of COVID-19, survive on surfaces for a period of time. And the most recent data suggests, and the WHO, the World Health Organization, will say that we think that this coronavirus lasts anywhere from a few hours to several days. So that we know. We don't know exactly how much that contributes to transmission of the virus and the infections to other people. But we want to be cautious, and every public health organization advocates cleaning. So what are the things that we've done? They understand better what kills this coronavirus, and so there are certain standard cleaning agents that don't work. So we've switched over to what the recommendations are around cleaning, and that mostly is ethyl alcohol products or bleach-containing products, which we know are effective at killing the virus. And so under normal circumstances, we've enhanced our cleaning in terms of using these products, being more vigorous about cleaning more surfaces, performing the cleaning more times a day, and really paying attention to what we call common touch points, meaning elevator buttons, door handles, pantry areas, so that where people are frequently touching, we're making sure we're trying to clean as best as we can. If there is a case, and you'll see this everywhere, it's not just a Goldman Sachs, if there is a case of an infection in the workplace, we know that perhaps in that area where the person was and maybe sort of on the floor where they might have been, there could be some virus that remains behind. And so that's what we call a deep cleaning, where they really spend an extra amount of time really cleaning all the surfaces, either in that workspace, in that area, on that floor. And we do that, on the evening after we identify a case to make sure we're really trying to eliminate the virus on surfaces as much as we can.
We all have responsibilities here as managers. You manage our health centers around the world. How can managers be helpful in creating a more comfortable and flexible environment as we work through this?
Well, listen, we're all in this together. And so the important thing is that we really support each other. And I think as a manager, we always want to be listening to our employees' concerns, but I think especially at this time, we want to be extra patient. We want to be checking in with our people. We want to understand if they have, anxieties. We want to understand if they're having trouble being productive or getting through their work, how we can make things easier for them. I think that's very important because I think that, keeps us as a team very productive. And so I think that also making sure as a manager that these precautions we're talking about, that people are washing their hands, using hand sanitizer, reinforcing some of these messages are really important. And then, of course, the use of, technology and doing phone or virtual meetings it would be great. It's great to use virtual meetings if they're available because you can have some face-to-face contact and some social contact, even if you can't be in the room at the same time.
So obviously, for a lot of employees, the vast majority of our employees are healthy today, but it's still trying times emotionally and psychologically. What resources does a firm like Goldman or more broadly offer for employees in that state?
Yeah, I mean, I think most firms have what we call an EAP program, which is called Employee Assistance Program, that offers short-term counseling. And we do it at Goldman Sachs on-site and person-to-person. We also do it off-site person-to-person. And finally, we do it telephonically. And so using, again, a virtual appointment with a counselor, whether it be telephonically, in our case, sometimes some other firms use video visits, is really important to be able to just speak to someone, express your anxiety, express your concern, get some short-term support. I think that EAP is really important to make sure people are aware of that so they can get the support they need. We also have an online portal called Mequilibrium, which is a resilience program that we offer. People can go online, they can do an assessment, they can understand what their specific stressors are, and then they have online programs to help manage through that. There's a meditation, I think, part of Mequilibrium. People can actually just download meditation apps on their phone. I think meditation is a wonderful thing for us to be doing. You know, a lot of us, we can't go to the gym anymore. There are a lot of our physical activities that have been limited during this period because of the government-related social distancing, closing a lot of social activities. Putting an app on your phone to meditate and spending some time meditate, I think really would help get you centered. And those are the kinds of things I think are important. We've tried in Asia to do a few things, some programs. We have some written materials on our COVID website. Sometimes we've done some meditation classes virtually. I mean, those are the kinds of things I think that keep us centered and focused and calm. I think keeping calm is really important in this environment.
So Dr. Rendell, you mentioned our locations in Asia. They've been living with it for a lot longer than we have here in the U.S. or in Western Europe. Talk a little bit about the status of our operations in Hong Kong, which has been really in the middle of COVID-19 for 2 months.
Yeah, I've been so impressed talking to the Asia teams about how things are going there, because what we're just starting to experience now in the U.S., they've been living with for 6 weeks. And I think what I'm finding from speaking to them is after they're going through all these different phases that I expect that we will go through. In the beginning, trying just to adapt to the new environment that we're in, which is this, social distance environment, this work from home environment. It's so opposite to what we're used to because we're by nature social animals. Getting used to that, dealing with school closures, which we're seeing now happening in the U.S. How do I manage my children at home? How do I work and my children are home at the same time? I'm seeing all these things that they've been able to work through really in an amazing way. The people in Hong Kong and more broadly in Asia have been exceptional when I speak to them and I hear what they're doing. What's really interesting is I think you sort of go through these phases where the first phase is sort of this batten down the hatches and get ready and for what's to come. And then you sort of get used to it's your new reality. You realize that living, working from home and living at home, which is not what you're used to doing, is full time, 24/7. And so now, as the epidemic sort of lightens up in Asia, interestingly, Hong Kong, Singapore, and even China have many fewer cases than we see in Europe and in the U.S. They're sort of ready and anxious, I think, to go back to work to some degree. And so we see more people wanting to come back into the office, more people getting used to the idea of how do you live in this environment where maybe you're not using public transportation or you're being mindful of your individual social distance, but they're really really anxious to sort of regain coming back into the experience of being in the office. And so I think we'll go through all that just like they did, and I'm sure we'll do it just as successfully, but it's been very interesting psychologically to see how that's evolved over there.
Well, you bring up an interesting point. You and I spent a lot of time trying to develop a global message for this firm, but obviously it's very hard to have a uniform approach when the regions have very different experiences. To talk a little bit about the trade-offs between trying to have a consistent approach for all of our firms and one that acknowledges some of the big regional differences right now.
Yeah, I mean, I think that it's really interesting that all the different methods that government is putting in place, and we have to react to that in every region that we're in. And so travel restrictions, temperature screening, isolation policies, they really vary from place to place. And while, for instance, wearing masks may be commonplace in Asia, particularly in China and Hong Kong, they're very rarely used in the U.S. and really sort of discouraged as a method of mitigating spread of the virus. In Western Europe and the U.S., they tend to emphasize social distancing is the best thing to do, and so you don't see something like that culturally. That's sort of a difference we see between Asia and Europe and the U.S. On the other hand, childcare is something that we are mindful of globally that everybody has to deal with, and how, because many places schools are being closed. The work from home environment is sort of the same. Again, it's that, sort of major reducing the ability for people to interact with each other. And so in general, although we apply the same principles everywhere, we really want to be mindful of, both cultural differences, government differences. All those things play a role in how we sort of manage from place to place. And even though we're one united firm.
So you mentioned a couple of times the challenges of working from home, and I myself, being brand new to it, have plenty of challenges. I think I need to teach my children to meditate. But working from home is isolating. It's not something people are generally familiar with. Some advice for those on how to remain calm and productive when they're working from home?
Yeah, I would say a couple of things. One, set up your workstation. This will be your workstation for the next 6 weeks or so, or maybe longer, or maybe less. It's hard to say. Make sure you have a comfortable workstation. You won't have an ergonomist and a special chair and a special monitor and all the things that luckily we're able to support you and bring to you at Goldman Sachs. But you have to do the best you can with your laptop instead of a desktop. Find the right chair for you. Make sure you have a comfortable environment, that the lighting is right, because that makes a huge difference. We all know that. That makes a huge difference in how productive we are. 2, think about what you're going to do for your taking breaks, making sure you have time that's quiet for you, time you can spend with your kids so you don't get anxious you're not spending enough time with them or paying enough attention to their needs. Figure out a way to get some exercise. I think that's really, really important. Where I live now, we have some trails near my house. I can't go to the gym anymore. I can't ride my bike because it's winter, but I'm going to start doing a lot of walking. I think that's a really important thing for us to do. And then again, I think make sure you're communicating with others. We're social animals by nature, as I've said before, and make sure you're keeping in touch with your friends, with your colleagues, and making sure that's built into your day, that you're having enough social interaction.
Well, we just need a break from all those conference calls that you and I are on. Michael, there's obviously a lot of information out there today and a lot of misinformation and faux experts on this topic. How do you yourself make sure that you're getting the best information that's available and stay up to date on the relevant developments?
Well, first of all, I go to websites, both global and government-based, that help give me great information. For instance, the World Health Organization, the Centers for Disease Control in the U.S., the National Health Service in the U.K., all those have great websites with a great deal of information. It's very useful. They're updated on a regular basis, so we understand what their guidance is. There's a lot of useful medical information there. We also have some experts, both infectious disease experts and global travel experts, that give us information on a daily basis and make themselves available to us for questions. So as this pandemic, which is rapidly evolving and changing, we can keep current with what's going on.
Well, Dr. Rendell, thanks for joining us today and sharing your wisdom with us.
Happy to be here. Thanks for inviting me.
That concludes this episode of Exchanges at Goldman Sachs. We'll be back later this week with a markets update from Tony Pasquarella from our Global Markets Division. If you enjoyed the show, please subscribe on Apple Podcasts and leave a rating or comment. Thanks for listening and be safe out there.
All price references and market forecasts correspond to the date of this recording. This podcast should not be copied, distributed, published, or reproduced in whole or in part. The information contained in this podcast does not constitute research or a recommendation from any Goldman Sachs entity to the listener. Neither Goldman Sachs nor any of its affiliates makes any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast, and any liability therefor, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. The views expressed in this podcast are not necessarily those of Goldman Sachs, and Goldman Sachs is not providing any financial, economic, legal, accounting, or tax advice or recommendations in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by Goldman Sachs to that listener, nor to constitute such person a client of any Goldman Sachs entity.
Welcome to our Exchanges at Goldman Sachs Markets Update for Friday, March 13th. Each week, we sit down with leaders across the firm to get a quick take on the markets. I'm Jake Siewert, and today's guest is Alex Blanchard of our Global Market Division. Good morning, Alex, and welcome to the program.
Morning, Jake. Thanks for having me.
So, Alex, just quickly explain your role here at the firm and who your main clients are.
Yeah, sure. I'm responsible for the firm's global short-term rates and repo business. You know, we typically interact with large institutional clients across the levered space, so large asset managers and hedge funds, as well as large money market funds in the 2A7 complex.
All right. Well, since the repo market's been in the headlines, give me just a quick overview of what's happening in that market in recent weeks.
Yeah, absolutely. So we saw early signs of pressure over the last couple of weeks, and while much of that was manifesting itself kind of away from the part of the market that most people had been focused, most specifically the overnight repo market, I think there was a period of time when perhaps the observers might say that things were all calm, but in reality things were far from calm. You know, essentially what we've been seeing is an increase in the cost of financing, both in repo markets for liquid securities, as well as in the commercial paper market, and as well as in the offshore financing markets, notably the cross-currency basis market. If I just try and unpack that, essentially what happened was a combination of factors. First being, as the market started to price, change expectations for monetary policy, the money market curve inverted. As that happens, money market investors, who are the marginal supplier of funding or liquidity into the space, typically in that situation tend to shorten the duration of their asset side portfolio. So differently, given that they are focused highly on advertised yield rather than total return, their incentive is to keep their cash in the overnight repo market and not lend it to somebody who wants to borrow it for 3 months or 6 months. And so the cost of financing for people who do need to borrow for 3 months or 6 months definitionally had to increase. At the same time, what we started to see as we have these heightened levels of volatility in markets was a drain of kind of liquidity across the system. If you think about, banks are posting and receiving margin to one another all the time, and alongside their large clients, when I post margin, I take cash away from my repo desk, and while you then, if I'm posting to you then are able to give that cash to your repo desk. There's some delay in that process. So a phrase that the Fed have used historically, the velocity of reserves is not as high as it needs to be, and so ultimately that means that the system requires more reserves. This is then the final thing I'll say on that. This is then filtered into the treasury market. Normally, you have a cohort of investors who would buy securities when they looked cheap and sell securities when they looked expensive, or buy one security versus the underlying derivative. But given the focus on ALM or asset liability management from both them and the banking sector, which may appear somewhat virtuous, it almost becomes self-fulfilling and starts to become somewhat pro-cyclical. So we've seen more and more pressure, and the levels that we've reached in various funding markets is reaching very, very stressed levels.
So the treasury market is typically one of the largest, most liquid markets in the world. So the Fed obviously responded this week, injected capital into that market amidst all the volatility. What signal were they trying to send, and what's been the impact of that since the announcement?
Yeah, great question. So the Fed have been, I think, grappling with, what is it they need to do and how. We'll all remember the period of time during September of last year when there was a lot of pressure on the repo markets, and the Fed responded by injecting reserves into the system. in order to help banks provide more lending to those who needed to underwrite some dislocations. They've done something very similar over the past few days, initially responding with a combination of around $300 billion of term operations. And then additionally, yesterday, they announced a total of $1.5 trillion of term operations across 1 month and 3 month lending. The response from the market has been interesting because the take up of that $1.5 trillion of lending was less than $120 billion. And so I think that highlights the challenges that the market faces, where the Fed were trying to just set both size and price by offering as much possible cash as they could. They say to the market, you don't need to pay in a competitive auction process. You don't need to pay more than the kind of regular market clearing rate for this. So we want to really tighten the spreads between repo financing and monetary policy. But the banks are essentially responding by saying, increase our balance sheet in order to take down your reserves and lend them out. And so, what the market is crying out for is a more direct injection. Now, literally in the last half an hour, the Fed have announced an additional operation where, alongside their temporary open market operations, they had plans to buy a combination of U.S. Treasury securities across the curve over the course of the next month. They have announced today that they will be buying $37 billion today alone. So instead of spreading out the total operation across the month, they're making more decisive action today.
So what does that mean now for U.S. Treasuries and other risk assets?
Separating those 2 points, I think for U.S. Treasuries, you would expect to see, and we've started to see, a richening in U.S. Treasuries versus underlying derivatives. So 30-year swap spreads have richened the best part of 10 basis points, 7 or 8 basis points as we speak, since the announcement. And so I think the Fed are doing what they can to get cash directly into the system, and that should help in some part. Although what it's really not doing, it's pulling forward the injections. It's not necessarily injecting more cash. It's just saying, instead of the system having to wait to get more cash into the system, we'll do it all today. So it should help, but it's not obvious to me that it has a drastic impact. The reality is you need more underwriting of these dislocations and more ability to do so, where the Fed seemingly are the only ones who can do that. In terms of risk assets, I think that's separate and distinct, right? While some of these dislocations have been driven by moves in risk assets and VaR shocks, driving behavior from investors either to reduce risk or not be willing to increase risk in these dislocations. When you remove these dislocations, that doesn't mean that people's perception around what's going on in the world has necessarily changed, and that their inclination to buy stocks has changed.
So how are your clients responding to this very volatile environment? Are they just taking risk off, or are they active?
I'd say it's a mix. Across the different complexes we touch, there is certainly some risk reduction. People run, very, very tight risk limits across different institutions, and there's definitely been some degree of risk reduction. And when you have that in both volatile but also thin markets, that drives substantial dislocations. You've also seen beginnings of a rotation from some investors who are purely sourcing their long-dated duration in derivative product. They are starting to deploy some of their long-dated duration into Treasury product. That's essentially unwinding received fixed swaps and buying U.S. Treasuries in order to richen Treasuries versus swaps. And as I said, from the money market investors, where a lot of this all begins, it's an interesting set of circumstances where they're continuing to have large inflows as risk assets go down. Obviously, the amount of cash held by money market funds increases because you and I take our money out of our S&P holdings and put it into our money fund. And so you had somewhere like $80 billion of cash into the money market complex, which is bearing on $4 trillion right now. But they're all continuing to keep their money very, very short. So their willingness to lend out will only change once as I started in the preamble, once the money market curve disinverts. So there are a few things I think the market is looking for from the combination of the Fed and U.S. Treasury. The market is crying out for a substantial interest rate cut from the Fed. The market's pricing the best part of 100 basis points or 100 basis points over the next week.
Basically down to zero.
Yeah, exactly. Moving the range to
0 to 25 basis points. And that, I think, needs to happen in order for the money market curve to disinvert. And then the question will be what other tools do the Fed have in order to fix what's going on in short-term credit markets. And so we would expect them to use some combination of facilities that they used during 2008, either the term auction facility or the term asset-backed lending facility, in order to provide direct capital to short-term credit markets. At the same time, we're also watching very closely what's going on in offshore financing markets and the cross-currency basis, which is something that a lot of people will watch, where the market is currently implying that for a Japanese bank to lend yen and borrow dollars, the average cost of that over the course of the last year was in the order of about 30 or 40 basis points, is currently around 200 basis points. And the Fed have a facility that they have in place where they allow central banks to lend local currency and borrow dollars, and that's struck at 50 basis points. And though the market is pricing way beyond that, because there appears to be some stigma attached to the use of swap lines. And so we think that the Fed should work collectively with global central banks to, one of either or both, change the rate that is charged on the FX swap lines, but also ensure that other global central banks encourage the use of them in order to avoid these dislocations. Because the alternative of not doing these things is very impactful, way beyond you and I talking here about the funding markets, and can start to affect the real economy. And the two places I'm most concerned are as follows. The first, if you continue to see these dislocations in the cost of borrowing for Japanese banks, then they will have no choice but to pay whatever it costs to borrow money in the short-term credit markets, in the commercial paper market, and that will start to have an impact on the cost of financing for non-financial corporates. The second is if you continue to see these dislocations between U.S. Treasuries and their underlying derivatives, the one that we watch very closely is the difference in valuation between the cheapest to deliver securities in U.S. Treasury futures contracts and the future itself, which exists really because there's a large buyer base of futures in the asset management community who are hedging their long-dated liabilities with futures contracts and then investing their cash into credit product. And then they are able to buy those futures because somebody is selling them to them, obviously. The sellers are people who are buying U.S. Treasuries and then selling futures. And that spread, that implied financing spread, has typically been around 40 or 50 basis points. That's upwards of 200 basis points currently, and is getting to levels now where it makes more sense for the asset manager to stop buying futures contracts to hedge their duration, stop buying credit as a cash reinvestment, and deploy their cash entirely into U.S. Treasuries, because U.S. Treasuries are looking extraordinarily cheap versus things around them. That would not be a good outcome for the functioning of the credit markets. And so while we look and the things that we follow very closely in financial markets seem to be purely a financial instrument and not necessarily touching the real economy, the reality is that if things persist, then it could start to have a very marked impact on the real economy.
So, Alex, you mentioned that the market's looking for some of the 2008 playbook to come back, swap lines and term auction facilities and the like. Are there any other big measures that the Fed or Treasury might be considering, or that the market is looking at, more creative or newer versions of measures to restore some of the liquidity and stabilize markets?
Yeah, sure. I mean, what they might consider, and similar to what we've seen from other central banks over the last few days, is some form of regulatory relief in the short term. One of the things that the current market environment is highlighting is that there is some element of the regulations which is pro-cyclical. And so to the extent that banks were able to provide more lending into this environment rather than less lending in this environment would actually help. That could be done through either a tweak to the liquidity coverage ratio, allowing banks to recompose their asset holdings away from liquid securities into credit product, at the same time as opening the facilities you just touched on, the discount window and the term auction facility and the like. Alternatively, some kind of relief on the new proposed stress capital buffer in order to allow banks to grow their footprint and be more present and providing intermediation capacity, which is essentially what is constrained currently.
Interesting. I also saw some talk about buying off the run bonds. That was done when the U.S. Treasury is running a surplus. Is there any talk of that coming back?
There's been some recent commentary around that. The meaningful dislocation in the Treasury complex is exactly in that space, Jake, in the off-the-run space. So as the fiscal goals from the U.S. government have been as they are, and we've had heightened levels of issuance, by definition, that creates more and more off-the-run securities. Because every time you issue a 10-year security, then a year later, it's now no longer the on-the-run security, or an auction cycle later, it's no longer the on-the-run security. And as you get more and more off-the-runs, and most liquidity continues to exist in on-the-runs, then these dislocations in periods of stress or in periods where private capital is unable or unwilling to underwrite, they become more and more illiquid. And so recommendations around the U.S. Treasury being able to buy back some of the off-the-run securities and then issuing new on-the-run securities would certainly help remove some of these dislocations. Well,
Alex, a fascinating discussion. Thanks for joining us today.
It's my pleasure. Thanks for having me.
Well, I hope we won't have to have you back regularly, but it was great to have you on.
I'd be happy to. Yeah, thank you.
That's all.
I agree. Let's hope not.
Yeah, that's all for this week's market update on exchanges at Goldman Sachs. Thanks for listening, and tune in again next week for more updates on the volatility. In case you missed it, listen to this past Tuesday's episode with Jeff Curry of Goldman Sachs Research, who explains what's going on in the oil market after the sharp drop in prices there. This podcast was recorded on March 13th, 2020.
All price references and market forecasts correspond to the date of this recording. This podcast should not be copied, distributed, published, or reproduced in whole or in part. The information contained in this podcast does not constitute research or a recommendation from any Goldman Sachs entity to the listener. Neither Goldman Sachs nor any of its affiliates makes any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast, and any liability therefor, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. The views expressed in this podcast are not necessarily those of Goldman Sachs, and Goldman Sachs is not providing any financial, economic, legal, accounting, or tax advice or recommendations in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by Goldman Sachs to that listener, nor to constitute such person a client of any Goldman Sachs entity.